The world of high finance often seems impenetrable, a realm of giants, nations, central banks, institutions with power that could shake continents. Yet sometimes a single mind armed with a daring idea and nerves of steel can challenge the titans. This is the story of such a moment. A moment when one man, George Soros, stared down the might of the Bank of England. He wielded capital, but more importantly, he wielded an understanding of market psychology. His name would become synonymous with a day of financial reckoning. Black Wednesday, a day when the British government fought a desperate losing battle to defend its currency. Soros wasn't just a bystander, he was the catalyst. He was the architect of a trade so monumental it would earn him the moniker, the man who broke the Bank of England. He saw a flaw in European monetary policy. He identified a pressure point and he pressed hard. The reverberations of that single, focused campaign would echo for decades. This wasn't merely about making money, it was a demonstration, a stark, brutal lesson in how markets function. He was about to demonstrate on a global stage that sometimes the whisper of a single, well-placed bet could indeed grow into a roar that toppled an empire's financial defenses. George Soros wasn't born with a silver spoon. Born Georgi Schwartz in Budapest, Hungary in 1930, he experienced the rise of Nazism and the horrors of World War II firsthand. These formative years instilled in him a profound understanding of risk and the fallibility of established orders. After the war, with Hungary falling under communist rule, Soros sought refuge and opportunity elsewhere. He made his way to England in 1947, a penniless immigrant. He worked odd jobs while studying at the London School of Economics. It was here he encountered the philosopher Karl Popper. Popper's ideas, particularly his concept of fallibility and his advocacy for an open society, resonated deeply with Soros. These philosophical underpinnings became the bedrock of his investment strategy. He saw markets as flawed systems influenced by human bias and error. His journey into finance began in the 1950s, first in London and then in New York. His financial career provided the arena to put these insights into action, leading him inexorably towards the moment that would define his legacy. In the early 1990s, Britain found itself in a precarious economic position. The government, led by John Major, was grappling with inflation and seeking stability. The solution, it seemed, lay in Europe, specifically the exchange rate mechanism, or ERM. The ERM was designed as a stepping stone towards a single European currency. It aimed to reduce exchange rate volatility and achieve monetary stability among its member states. For Britain, joining in October 1990 seemed like a path to discipline. However, the ERM was a demanding master. It required member countries to align their economic policies, particularly interest rates, with those of the stronger economies, notably Germany. This became a significant problem for Britain. The German economy needed high interest rates to combat its own inflation, but the British economy was struggling. High interest rates, necessary to keep the pound within its ERM band, were an economic straitjacket. The UK was essentially importing Germany's monetary policy regardless of its own domestic needs. The situation was a classic economic dilemma. The pressure was building, and the cracks in the facade were beginning to show. George Soros, through his quantum fund, had been watching the European currency situation with intense interest. He and his chief strategist Stanley Druckenmiller saw the internal contradictions plaguing Britain's membership in the ERM. They believed the pound sterling was fundamentally overvalued. The high interest rates required to maintain its ERM parity with the Deutsche Mark were strangling the British economy. Soros's theory of reflexivity suggested that once a strong enough belief formed that the pound would devalue, that belief itself could help bring about the devaluation. He wasn't just observing, he was looking for the opportune moment to act on his conviction. Soros began to build a massive short position against the pound. This meant borrowing pounds and immediately selling them on the foreign exchange markets with the expectation of buying them back cheaper after a devaluation. By September 1992, the Quantum Fund had reportedly amassed a short position against the pound worth around $10 billion. Other speculators, seeing the logic in Soros's play, joined the fray. The selling pressure on the pound intensified. Soros had effectively painted a target on the pound's back. The storm broke on Wednesday, September 16, 1992. This day would forever be etched in financial history as Black Wednesday. The British government, led by Prime Minister John Major and Chancellor Norman Lamont, woke to a full-scale speculative attack on the pound. George Soros's quantum fund was at the vanguard, but a legion of other traders had joined the assault. The Bank of England was thrust into a desperate battle to defend sterling's honour. The government's first line of defence was direct intervention. The Bank of England began buying pounds sterling on a massive scale, using its foreign currency reserves to prop up the price. Billions were spent in a frantic attempt to absorb the selling pressure. But for every pound the bank bought, speculators like Soros sold more. The government then resorted to a more potent weapon: interest rates. In a dramatic move, Chancellor Lamont announced an increase in interest rates from 10% to 12% in the morning. But the market barely flinched. Later in the day, with the pound still plummeting, Lamont announced a further interest rate hike to 15%. By the evening of Black Wednesday, it was clear the battle was lost. That evening, Norman Lamont announced that Britain would suspend its membership in the ERM and allow the pound to float freely. The immediate aftermath of Britain's exit from the exchange rate mechanism was dramatic. The pound sterling, unshackled from its ERM chains, plummeted in value on the foreign exchange markets. For George Soros and the Quantum Fund, this was the moment of triumph. Having shorted billions of pounds, they now bought them back at the new, lower rate. The profit from this single, audacious series of trades was estimated to be around $1 billion. For the United Kingdom, the fallout was multifaceted. Economically, the devaluation, while initially seen as a humiliation, paradoxically provided a much-needed stimulus. A cheaper pound made British exports more competitive, helping the economy to eventually pull out of recession. Interest rates, no longer yoked to Germany's needs, could be lowered to support domestic recovery. The government's economic credibility had taken a severe blow. The reputation of the Bank of England, and indeed the British government, was significantly tarnished. Black Wednesday became a symbol of policy failure, a stark reminder of the power of global financial markets to overwhelm even sovereign governments. George Soros's legendary trade against the British pound was not merely a lucky guess or a brute force application of capital. It was deeply rooted in his philosophical understanding of markets, particularly his theory of reflexivity. Unlike traditional economic theory, which often assumes that markets tend towards equilibrium, Soros believed that markets are inherently unstable. This concept of a two-way feedback loop between perception and reality is the core of reflexivity. He didn't just analyze fundamentals, he analyzed how others would react to those fundamentals. In the case of Black Wednesday, Soros saw that the British pound's position in the ERM was fundamentally flawed. He believed that as this reality became more apparent, market participants would increasingly bet against the pound. This selling pressure, driven by perception, would then force the Bank of England into even more desperate measures. He wasn't just anticipating a market move, he was anticipating how the market itself would amplify that move. For the pound trade, Soros and Druckenmiller calculated that the probability of the pound devaluing was overwhelmingly high. Soros's application of reflexivity gave him an edge. The Black Wednesday trade was a masterclass in this approach. The aftermath of Black Wednesday cemented George Soros's image in the public consciousness, but it was a deeply divided one. To many in Britain, he was the man who broke the Bank of England, a ruthless speculator who had profited from their country's misfortune. He became a convenient villain, embodying the perceived destructive power of unchecked global finance. Conversely, others viewed Soros as a visionary, a brilliant market analyst who had simply exposed the fatal flaws in a poorly conceived economic policy. From this perspective, the ERM itself and Britain's adherence to an overvalued exchange rate were the real culprits. Soros, in this light, was merely the catalyst who forced an inevitable and ultimately beneficial correction. Beyond the realm of finance, Soros channeled his immense wealth into another sphere, philanthropy. Through his Open Society foundations, he has poured billions into promoting democracy, human rights, freedom of expression and education around the world. The man accused of destabilizing economies was also one of the world's leading proponents of open democratic societies. The debate over George Soros continues to this day, fueled by his ongoing financial activities and his outspoken political and philanthropic engagement. Is he a predatory speculator, or a pragmatic market realist, a destabilizing force, or a champion of open society? His actions on Black Wednesday were undeniably impactful, reshaping Britain's economic trajectory and earning him a fortune. The saga of George Soros and Black Wednesday offers more than just a thrilling financial tale. It provides profound lessons about market psychology, the dynamics of crowd behavior, and the inherent vulnerabilities within even the most robust-seeming financial systems. One of the most critical takeaways is the power of perception and narrative in driving market movements. Soros didn't just analyze numbers, he understood that if enough people believe something will happen, like a currency devaluation, their collective actions can indeed make it happen. This is the essence of reflexivity, where belief shapes reality in a continuous feedback loop. The event starkly illustrated the phenomenon of herd behavior in financial markets. While Soros and the Quantum Fund may have initiated the major push against the pound, their actions signaled a vulnerability that other traders quickly pounced upon. Once a trend gains momentum, many participants will follow, not necessarily because of their own deep analysis, but because they see others profiting or fear being left behind. This cascade effect can amplify initial movements exponentially, turning a manageable pressure into an overwhelming force. It highlights how quickly rational analysis can be swamped by collective emotion, be it fear or greed. Black Wednesday also served as a harsh reminder of the fallibility of governments and central banks when they attempt to defy strong market fundamentals or overwhelming speculative pressure. Ultimately, the story of Soros versus the Bank of England underscores the enduring human element in finance. The echoes of Black Wednesday continue to resonate, reminding investors, policymakers, and the public alike that the seemingly solid ground of financial markets can quickly turn into an abyss if the powerful undercurrents of psychology and crowd dynamics are ignored. So what does George Soros' story teach us? That markets aren't machines, they're psychological battlegrounds. And sometimes understanding the crowd better than the crowd understands itself can make you a billionaire. This was episode 2 of Legends of Investing. Next up, the rise, fall, and epic comeback of Ray Dalio, the man who lost everything and rebuilt one of the world's most powerful investment firms. Subscribe and stay tuned.